Well, welcome. Greetings and salutations, test takers. This is our free office hour for paid students. So people who paid for tutoring or class are welcome to join us with any questions they have. And we'll get started here and see what we got going on. Boom, boom, boom. It looks like we got some familiar people here. You know the drill. We put our questions into the chat and we go around the horn answering whatever questions it is that people have for that. Let me see if I can get the. Let me set my doorbell so if somebody else wants to join us. There's Charlotte. Participants, ring the doorbell. How do I make my doorbell ring? Doorbell. There we go. All right, so chat is open. Just put in the chat whatever you'd like to talk about. Maybe it'll be an easy office hour. Nobody has any questions. We'll just call it a day. I'm totally okay with that as well. I'm sure Charlotte's probably got a couple questions. She usually has a to-do list. Charlotte, you got anything for us? It looks like the other folks don't have any questions. Do you have anything?
Oh yeah, just give me 1 second.
I
Well,
told you, I told the ladies, I said, she's reliable. I bet she'll have some questions. Now, Charlotte's taking Series 7. Dana, I think you're 7 as well, right? 766. Oh,
66.
66. Okay, well,
Yeah, I
I'll
just
comment
finished
if
my seven.
Charlotte's 7 questions are appropriate for you or not.
Okay.
Alexandra, what's your series exam?
Seven, the seven.
Oh, there you go. There you go. All right. So, did you find them, Charlotte?
I can put them in one at a time, or I can
Yeah,
put
yeah.
a whole
Well,
list
let's take it
together.
one question. Yeah, yeah. Are they all Kaplan?
They are all Kaplan. I'll just put them all in there,
Okay,
and if
so
we don't
Kaplan
get through
Quebec.
them, then
Yeah, let me bring up my Kaplan Quebec, and we'll do just bringing them up backstage. We help anybody with any questions they have from any test prep vendor. We're agnostic about that. It's just easier if it's a Kaplan question because I have access to the Kaplan Q Bank and I can bring it up by the QID number. If you don't have a Kaplan Q Bank, I highly recommend it as a paid supplement. With my Guru 15 discount code at checkout, you can get over 3,600 performance opportunities in the Kaplan Cubic with a performance tracker, which helps you identify things you may be weak in or strong on because you want to find those things, right? You want to find your weak areas before you actually go take the test. I would get fired if I worked at the Prometric site because if you were coming into the Prometric site and I say, Charlotte, what do you know about Series 7? And she says, I'm about to find out. I'd say, oh, that's bad, Charlotte. You should know what you're weak on before you get here. You shouldn't be taking the real test, finding out what you don't know. You should kind of have an understanding of, what kind of draw is going to be a good draw for you. We should hopefully take down any draw, but, hopefully get a good draw. I think one of the reasons we don't give people their score anymore is because people would come back and chat up their score when it was a high score. And sometimes, yeah, did they work? Yes, but it also is a form of, getting a good draw with the stuff they were prepared for. All right, so I'll tell you what we'll do. Let's do the 7, and then I'll bring up the 66, and we'll do 7, 66, 7, 66, and then if nothing else is, we'll knock out the rest of Charlotte's 7s. And then that way, Dana, you can, if you don't want to spend some more time with us, you're welcome to move on. Let's see. Let me see. I want to put that over in the chat. Let me get here, shared screen. Can you guys see my Kaplan Q Bank? Yes, no,
yes,
maybe.
yes.
All right. So first one is 1558236. A customer purchases an XYZ municipal bond at 108. So first thing we have to recognize as a test taker is that this is a municipal bond purchased at a premium. The IRS thinks you don't take your last buck and buy a muni bond. They think that if you own municipal bonds, you have other investments. That assumption is correct. And they think that what you'd like to do, Charlotte, is buy this bond at 1,080 and realize that $80 loss whenever it's convenient for you. And I say, no, 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 Charlotte. Now, because what we think Charlotte would like to do is take that loss when she's got some gain from her tech stock or something. And the IRS says, no, 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 Charlotte, you're going to have to take this in little itty bitty hits along the way. So that at maturity, you have neither a gain nor a loss. So she doesn't get to elect. Elect means she gets to choose how to do it. They say, no, 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 you got to do it this way. You know, they amortize it downward, not a test term, a dean term. I call this decretion. Straight line amortization upward, very testable. That is a test term. Accretion. That's testable. Straight line amortization downward is testable, not the nomenclature of Dean's terminology decretion. And Kaplan got upset. I was teaching a class, and I guess they called it some Kaplan helpline, and the person didn't know what decretion meant. So, well, I don't know what to tell you. I mean, you know, I'd rather help you ladies rise up to the conversation than me swoop down, right? So, all right. People who, you know, my social media haters, I think it's funny because every once in a while I like to throw in some Latin in there, and you know, de minimis and that kind of stuff is Latin. So just to bug them the other day, I said it's the sine qua non. And I just knew they were going to go off there. Ah, there he is using that Latin again, you know. All right, so you got an $80 loss, assuming you hold it to maturity over 16 years. So as I just said, we got to take that loss along the way, Charlotte. About 50% of the time on debrief, somebody tells me they've encountered this where they've had to do practical application. So first step is 80 divide by 16. And so I'm going to have to amortize, adjust my cost basis $5 a year. See how I did that? That alone could have been a test question. I could say, how much do you have to adjust each year? And you'd say $5. So now it's that I've held it for 10 years. So now I'm going to times it by 10 years. And that means I should have adjusted my cost base downward $50. So my original cost base was 1,080. My adjusted cost basis is 1,030. And then it says I sell it for 102. So if my adjusted cost basis is 1,030 and I sell it for 1,020, I have a $10 loss. Any question on that? Now, I would say, Charlotte, there are three styles of questions you get on your 7. Recognition, practical application, and judgment. This is a practical application question. And we want to make sure we can do practical application questions because there's no interpretation of the right answer. You simply get it right or you get it what? Wrong, right? So
Wrong. Yeah.
practical application. Only about 10% of the exam is judgment. All right. Now, I was pretty impressed with myself the other day. I was able to bring up both Q banks at the same time, so I probably jinxed myself this time. Let's see if I can do that as well. Boom, boom, boom. Let's go find the 66 Q bank. Okay, are you still looking at the 7 Q bank, or did my new Q bank show up? I'll put it over here so I can tell the difference between the two.
The new one's up.
Okay, let me go. Boom. That was the one we just did. Okay, whip. Okay, looks like Dean's struggling a little bit here on my Q bank. Let me go do it again. Okay, I'm going to bring this back over here. I'm going to do this. And if not, I'll just shut it. Oh my goodness, look at that, Dana. Dana's putting more in there. It looks like it's going to be in every other one for a while. Okay, let's see now. 66 Q bank. I think I got this right now. Okay, can you see my Q bank now again? All right, cool. Okay, so now we'll bounce back and forth here. So Cube Dana is 153 6217. A bond with a par value of 1,000 and a coupon rate of 5 paid semi-annual. By the way, I shouldn't have to tell you the bonds paid semi-annually. You should know that, right? So that's kind of given information. So that's 5%. That's not going to change. That's $50, 2 payments of $25. It's currently trading for 1,200. And so that means since the bond was issued, interest rates have gone down, causing the bond to go up. The bond matures in 10 years and is callable in 6 years at 103. So issuers, most issuers, particularly corporate issuers, treasury bonds are not callable. Zero coupon bonds are not callable, but this bond is callable. So in 6 years, they can say, hey, give us back the bond. So it has call protection of 6 years, time and price, at 1,030. I think of that 1,030 as kind of a prepayment penalty to compensate you, Dana, for the payments you're not going to receive if we call it. By the way, this is appropriate, ladies, to the 7 as well. So far, I mean, I don't know, how the question's going to end, but so far this looks like an overlapping question from 66 and 7. Yield to call. So what they're asking me is, what is my effective yield going to be if we don't get to hold it to maturity? So I'm going to be losing $200 over 6 years. I'm either losing $200 to maturity, right? Because I paid 1,200, kind of like the previous question, or I'm going to lose 170, or excuse me, right? 1,200 to 103. So I'm losing either $200 over 10 years or $170 over 6 years. So to computate the yield to call, which of the following would not be a factor? Well, I wouldn't worry at all about this question, Dana. I wouldn't worry about this at all. But the interest payments is not a factor because the 50, what they're getting at, and I think this is why, as a tutor, I think this is not a question to worry about. What they're trying to ask, which will be more linear and straightforward on the test, is to know that nominal yield doesn't change. That current yield actually does change. Yield to maturity, yield to call do change based on the price. And when you buy a bond at premium, it's most likely it's going to get called, not that you're going to get to hold it to maturity. So that's the interest payments. Yeah, the amount of payments you're going to receive, the present value of 1,030. I just think this is a really terrible question. Yield to call, we don't have present value, future value, right? That has nothing to do with it. So what would be a factor? Which of the following should be a factor? It's the payment you're receiving over the remaining life or to the call. So again, I think a terrible kind of phraseology. All right, I'll tell you what, let's double up on a 66. We'll do another 66, then we'll go back and we'll do two to 7s. Next one is 152 1009. A portfolio manager consists is adding an asset to a portfolio. I like this. This is very testable. One of the underpinnings of modern portfolio theory is this idea of correlation and how adding negative correlation can add additional diversification. And positive correlation doesn't add as much diversification. So a portfolio manager decides between 4 equally risky assets, W, X, Y, and Z, the correlations of each asset within the portfolio. So it looks like they all have positive correlation. They all move in the same direction. But the one that moves the most in the same direction and therefore provides you the least liquidity would be asset W. They could ask this either way, by the way. Here they say optimal diversification, so we want the one with least amount of correlation. I would prefer that this was a negative number, but it's not. So given that answer set, it's asset Z. So again, I don't, Dana, care for the particular question, but I do care about the takeaway. I like the takeaway. This idea of positive and negative correlation and how it relates to additional diversification. Okay, did I accidentally kill my Kaplan Series 7 Q bank? I think I did. Oh, well, we'll just sign back in again. Series 7. Study tools, Q bank. Okay, we stop share. Let's go to the 7 Q bank. Boom. Can you see my screen?
Yes.
Okay, looks like we're going to do 2 on Charlotte's list. So she's got a Reg T question. Let's knock that one out. 155 9558. In a new margin account, this is very testable on Series 7. I call this stupid but testable. Oh, I see a trick here. Boy, Kaplan are such jerks.
Yeah.
Charlotte said I thought this was going to be 100 shares at 15, but it's 1,000 shares at 15.
Hmm.
And I thought it was going to be a question about the $2,000 or pay in full, and then it ends up being nothing about that. All right, so if we're going to get margin questions, we don't get a lot of them. We don't get a lot of margin questions, and they're pretty straightforward. So I'm not sure how much time you want to spend on margin.
I just,
However, I would know the classical margin equation, so I'm about to set this up. This is called the initial setup that Nina's doing, and then I'm going to do a mark to market. So to do the initial setup, we need to know classical margin equation. The classical margin equation, which is testable, and I would know, is long market value minus debit balance equals equity. So you're going to put up half, and I'm going to lend you half. I think the best analogy is like a home loan, right? Asset of the house minus the mortgage on the house equals equity on the house. And so this is what we call my initial setup, right? You had to deposit 7,500. If I say, Charlotte, how did you capitalize the purchase of your home? What I'm asking is how much did you put as a down payment? How much did you borrow? So that is our initial setup. And I definitely, as a test taker, would know the classical margin equation. Okay, so now what I'm about to do is the initial setup. Now I'm going to do what's called a mark to market. You know, one thing I love about our securities industry is every day is a new day. You know, customers get hung up on that. Well, it used to be. I said, well, it used to be, right? I say, okay, so now it drops to 12,000. So now I'm going to do my mark to market. We have 12,000 in long market value. You still owe the brokerage firm 7,500. Remember, when your house goes up and down in value, that doesn't affect the mortgage, right? If the house is going up or down, what it affects is your equity in the house. I think that's the best analogy for a margin account. So you still owe the brokerage firm 7,500. Boom. And I'm not being facetious. I'm arithmetically challenged. So if somebody offers me a calculator, I'm going to say thank you very much. So I'm not going to try and do that in my head. I'm going to take 12,000. I'm going to minus the debit balance, the mortgage, and I come up with 4,500 in equity. Okay, so let's see now. Well, what's the equity account? Well, Dean must have done something wrong because I'm not offered one of those questions. Did I mess up? Let's see. I bought 1,000. Oh, I sold short. Oh my God. How embarrassing. I did not do the RTFQ. Now, the good news about the math is if I've done the math and then it's not an answer available to me, then what do? I go, uh-oh. Okay, so now a much different question. So, Charlotte, you're going to get $15,000 from selling the borrowed stock. And then you have to put half of that with it. So I'm still going to do the same thing. I'm going to do a mark to market. And now it's going to be good news. You're going to have to put up half of that, 7,500. That's your Reg T requirement. So that means you're going to have 22,500 in cash in your account. That's called the credit register. And what I'm illustrating now is the classical margin equation short. So we have a classical margin equation long and a classical margin equation short. So you second ledger line represents what you owe, but in a short account, what you owe is not money, it is securities presently valued at 15,000. And that is our classical margin equation short. And then I said in these questions, what we want to be able to do is a mark to market based on whatever change they give me. So last time when I screwed this up, it was good news because or bad news because it went down. But if we're short, that's going to be good news. So I say, hey, Charlotte, you have 22,500 in your account in cash. If we went into the open market right now and bought back the borrowed stock and gave it back to the person we borrowed it from, we'd only have to come up with $12,000. I'm not suggesting you close your account, but equity always represents what you would have if you chose to close your account. Nobody's suggesting you do that. And again, my arithmetic skills are challenged and my ability to read the question properly is challenged. I take my calculator. I say 22.5 is what you got in cash. Your securities presently valued at 12, and I get 10.5 is your equity. And now I see that that is one of my answers. Thank goodness. Right. By the way, you have excess equity. If you want, you can short some more stock. You can withdraw some cash from this, whatever you'd like to do. I think the most important thing on margin is to recognize the classical margin equation long and the classical equation short. Right? Any question on that, Charlotte? Do I think you're going to have to do that in your exam? I do not.
Fantastic. That's good.
All right, let's do it. Your next one is municipal bond mark to market. Boom, boom, boom. And then we'll go back and pick up a couple for Dana. 1559366. A municipal dealer buys $100,000 of municipal bonds at a 3% yield less 3/8. The dealer marks the bond up by a half a point and reoffers them to his customers. The compensation on each bond. So if my markup is a half a point and bonds at point is $10. So I'm going to take my calculator, 1 divide by 2 times 10. That's $5. And that's what my markup is. It says for each bond. So the 3% yield less 3/8 is just a Jedi mind trick. It has nothing to do with answering this question. Right? So all that stuff about it's 100,000, 3% yield less 3/8 has nothing to do with it answering the question. The only thing that is relevant is I had a markup of a half a point, right? So that yield is going to be something different than that, right? And that's $5. They do have compensation questions like this. Usually, Charlie, it wouldn't be in the secondary market where there's a markup. It would be in a primary offering. I haven't had anybody in a long time tell me they had to know anything other about ad valorem taxes other than it is about GO bonds. It's the property tax. Taxes are the price you pay for civilization. More civilization you want, the more you're going to have to do. So I don't think you're going to have to calculate the mills here. But the mill is, again, your property tax. It's 0.001. So, 15 would be 0.015. You would times that by the appraised value. It's not the current market value. So again, I think this is an outrageous question. Are you going to have to do this on the test? No. But your home has a current market value of 150. The property assessor says, Charlotte, I don't care about that. The assessed valuation, by the way, is given. You don't have to calculate it, but it would be 80% of the 150. So 150,000 times 0.80 means the assessed valuation is 120. And then we would just times that by 0.015. In the real world, there are people who get upset because they have higher assessed valuations than they do current market value, right? So, $1,800. I feel sorry for some of these folks when, they bought the mansion like years ago, and then now the property taxes are more than the mortgage payment. All right, let's go back to Dana. Dana, here we go. There is our 66Q bank. We'll knock out a couple of yours. I think the next one is 1517940. Oh, gee whiz. It looks like I got way too many numbers in there. 1517940. An investor invests $18,000 in a mutual fund and signs a letter of intent for 25 grand. So no worries for you. You've told the mutual fund that you're going to come up with $7,000 within the next 13 months. And if you don't do so, not a problem. We're just going to back flag your account. It'll look exactly like it should have looked. So there's no harm, no foul in terms of filling out the letter of intent. I say, Dana, you're going to get additional fund shares. We're just going to put those in an escrow account from paying the lower load. If you don't fulfill it, we'll just, redeem those shares and back flag the account. It'll look exactly like it looked. 1 year later, so she's within the 13 months, but it's valued at. No, it's got to be new money, not money we've made you, Dana. It's got to be a new $7,000, fresh money. Now, with rights of accumulation, that would be okay, but not for the letter of intent, even though the customer made new investments. And that's what this is testing you on. It's testing you on, do you understand that if a customer signs a letter of intent, it's got to be new money, not money we've made you, right? So that's what this is about. The agent should remind the customer, yeah, that doesn't go towards meeting the break point. All right, let's see what our next one is. Our next one is 1521322. When giving advice to a large pension plan invested heavily in large cap stock, how to reduce risk, so risk mitigation. So I think the easiest way to mitigate risk is to buy insurance. And you should know that if you're protecting something, you got to pay the premium, right? You don't buy insurance and so you plan on wrecking. It's just in case, right? So I say, you know what I'm going to do is I'm going to buy some puts on the index. As the index goes down, the puts go up. And there'll be negative correlation. The money you're losing in your portfolio will be made up, some of it, by the money we're making in the puts. And so the answer is A, we're going to buy broad index puts. That's how we're going to hedge systematic risk. Increase the portfolio's diversification. Now, you should know that systematic risk prevails despite diversification. So you should have known B is not correct, right? So by process of elimination. Raise the correlation. No, that doesn't help either, right? Now, that's a negative correlation, perhaps. Increase the standard deviation. That means increase the volatility of the portfolio. No. So given that answer set, A is our best answer. Almost always on 66, by the way, the answer is buy a put. I can't think of a 65, 66 where it's not buy a put because it's mainly about how to hedge either a stock or a portfolio on the 65, 66. Ladies on your 7, you got way, way more stuff than that. Okay, we're going to do one more here before we go back to Charlotte. 1521322. Is that what this one was? 1521322. Okay, well, then that's the same question. 1512132. 151. That's not coming up. Is that a mastery or a something else? So we'll come back to that. We'll do a couple 7s and we'll come back to that. See if we can find it. If not, we'll go on to the next one. Sometimes it won't give me the QID if it's a mastery or midterm because Kaplan doesn't want test takers to compromise things. I had a class I was teaching and they did extremely well on the practice test we do on Friday. And my spidey sense said, man, are they really that bright? And am I really that great a teacher? I don't think so. And come to find out the previous cohorts were actually giving people the questions that were on this exam, which I thought was kind of stupid because who cares if you look good on a Friday and you fail on a Monday? I said, why are you trying to game the intellectual inventory that we're trying to take on a Friday? 1544 898. Many years ago, an investor bought a bond with a 5% coupon. I like this one. So, Charlotte, if the yield to maturity is 6.5, you should know based on your teeter-totter or seesaw that this is a bond at a discount. When the bond, oh boy, Kaplan has nothing to do with it. When the bond matures, you should know you're going to get your principal and your last interest check. So your principal is going to be $1,000 and your last interest payment is 25. So 1,025. So again, it had nothing to do about the yield to maturity, the bond being at a discount. They're simply asking what you get a redemption, right? So you get your principal and you get your last interest payment.
How do you solve for the 25?
What's that?
How do you
$50,
solve it?
right? You should know that 5%, very good question. You should not at some point be struggling with 1,000 times 5% is $50 in annual interest. And you should definitely know that annual interest, the interest is paid to you semi-annually.
Hmm.
So that means you're going to get two payments of $25 each year on this bond. If it was a J&J bond, January 1st, July 1st, you're going to get $25, right? That's half. You're getting half the $50 every 6 months. All right, let's see what our next one is. Our next one is 1612290. The customer bought a February 35 put. So they have a choice to sell the stock at 35. The current market value is 33. So when we get asked about premiums, they consist of two things: time value and intrinsic value. The current market value is 33 and the current premium is 2. So the first part of this question has nothing to do with the answer. It has nothing to do with the answer. Because when we were asked about the relationship, it's just about 35 to 33. So the intrinsic value is 2 points. There's no time value. And the term for that is parity, equal. Parity means equal. The intrinsic value, the end of the money equals the premium. Now, you would never see that in the real world. If you see that in the real world, call me. That is a great opportunity because in the real world, there'd never be an option trading at parity. You would be trading at intrinsic value plus time value. So that's a good get. This is just to mess you up, right? This 35 put at 5, the break even's 30. I'm a bear. I think that's a Jedi mind trick thinking you hope. I think what I'm trying to do here is to get you to think this had something to do with the question. And it really doesn't. But this has nothing to do with the question. That's a good get. You said you got that one. That's a good get. All right, we'll do one more, and then we'll go back to some Dana 66 stuff. Boom, boom, boom. I guess next time what I probably should do, Dana and then Charlotte, is probably just, ask you guys to reconvene with me, to go through all the ones, and then you can come back instead of. I don't think it's hurtful or harmful to be listening to other stuff. Anyways, let's see. We'll do one more. Got correct. Buy, stop, order. Ooh, I had permission. You guys are paid students, so I'll tell you what. Send me, just remind me I made this offer to you. I did a tutoring session type of orders yesterday. I felt I was on top of my form, and so was my test taker. And she gave me permission to put it on the channel. So it's up there as a premiere this Thursday. But if you guys want to watch it early, just let me know and I'll send you the link and you can watch it early. Anyways, buy stop. Let's see what this one's about. 155,904.04. Oh, come on, Dean. 155,904. Did I get it right there, Charlotte? Am I missing something? 15. It looks like it's got too many numbers.
I might have
Let's get rid of those fives. Let's see what happens. No,
maybe try 155.
155. I think try that already.
Okay, never
Oh,
mind. Then
four.
we can skip it.
All right, let's skip it. Let's go get Dana. Try some couple for Dana. Dana's next one is, let's see, one. I think we did that one. 1518474. Which of the following are exempt from registration under the Uniform Securities Act? Well, you should know if the market center is New York Stock Exchange, it's a federally covered security. So you should definitely know we're not going to have coordinator qualified number one because that's a federally covered security under NIMSMIA. Number two, banks, the regulator for banks is not the state administrator. It depends on the bank's charter, whether it's a state charter. The state's banking commission would be the regulator there if they want to sell securities to the public. If it's a federally chartered bank, it would be the Federal Reserve Board. So again, 2 is going to be exempt from registration. Equipment trust certificates issued by a railroad company regulated by a state or federal agency. Well, they have a different regulator, and it's called the Interstate Commerce Commission. So it's not they get a free pass. It's not that 2 is getting a free pass. It's not that 3 is getting a free pass. It's that they have a different regulatory authority. Don't you love I love the NASAA exams. The railroad company is called a common contract carrier. That's a transportation company, trucking company, airline, railroad. A debenture traded over the counter whose stock is New York. Well, so if the stock is New York, then the bonds are federally covered as well. So 1, 2, 3, and 4. Now, I think a lot of people get in the weeds on exempt securities for registration. And on the test, that's only 3 or 4 questions. And mostly it's about what we call non-exempt securities, securities that do need to be registered. So whenever you hear the word non-exempt, I would think corporate security. All right, let's look at our next one. Our next one is 152-18474. 151. Oh, there we go. Looks like there's 151-8474. There we go. Oh, we just did that one. 152-0970. Which of the following is most suitable for an investor who's aggressive? I kind of like this one. I don't like the phraseology, but I like what it's getting at. They say, hey, I'm comfortable with volatility, man. I always joke here, Dana, what I always use for this idea of volatility is going on a financial journey, right? If I'm going to Vegas, it's 180 miles door to door. That's if I go 60 miles an hour, that takes me 3 hours. But if I go 90 miles an hour, it only takes me 2 hours. But I would be taking greater what? Risk. My brother and I got into it the other day because I don't go 90 miles an hour, but my brother does. And anyways, I said, Chris, please, will you slow down? And then he got mad at me. If you don't like my driving, then you shouldn't ride with me. And I'm like, do you realize how ridiculous you are? I don't, I have the right not to get killed in a car wreck because you're going 90 miles an hour. So don't take it personal. Just slow down, please. Right. So which one of these stocks is going to move the fastest? That's the part I like. We should definitely know that beta is a measure of volatility. Volatility is risk. And we should have the expectation, Dana, this part is very testable, that we would want a greater reward for a beta of 1.3. I have a guy who works at a company and they do 401ks, Dana, and he goes out and does like luncheons where he brings in pizzas and he talks to them about their 401k and the mutual funds that are available. And he told me that one of the clients came to him at the break, and one of the customers at this firm, and he said, "I want to retire in 4 years. Which one of your funds should I pick?" He said, "Well, how much have you invested thus far?" And he told me the guy said he had invested zero. And I said, well, what'd you tell him? He said, I told him that I thought this answer was kind of fun. He said, I told him we don't have a fund with a high enough beta to get you from zero to retirement in 5 years. Right. I might also use this data in my practice when I was a practitioner, say, Dana, I have a beta that's a little higher than I would normally be comfortable with, but hey, what can I tell you? We don't have much time to get you to your financial destination. And so that means we're going to have to take greater what? Risk. Now, I like in this question that the guy told me he's aggressive. It stipulates the guy's aggressive. So I don't have to make a judgment call about the aggression. I like the question enough. Let's try the other one. Which of the following purchases is most suitable for an investor who is not comfortable with volatility and would like the least amount of volatility in the stock market as possible? What would the answer then be? D, right on, right? And that shows up as a test question about this. The LMN would underperform in a rising market, but outperform in a falling market, right? So very testable. That was a good one. All right, do we have one more here for Dana? Is that it for Dana? All right, so Dana's got one more. Okay, so 159, 1794. An investor purchases 200 shares of Affinage Refining Company at 63. Over the next 6 months, they pay two quarterly qualified dividends. So I would just know that qualified dividends are taxed at a lower rate than ordinary income. They're taxed at long-term rates. And you qualify by buying the stock 60 to 90 days from the record date. Who cares? The investor liquidated the position at 63. So you made $3 there. Your cost basis was 63. Your sales proceeds was 66. If the investor is in the 32% federal tax bracket, the appropriate after-tax return is. So we got 200 shares and we made three. That's $600. So 600 times 32, that's going to go poof. That's going to go to the federal government. We had 200 shares. We got $1 there, so we got $200. And then $200, I said, is going to be taxed at long-term rates, which is 20% or 15, depending on what you're doing, right? So here would be 15 or 20. I'm not quite sure how in the question you're supposed to know the 15 or the 20. But I would have known the 32, right? So then we tell you how to do the math. We come up with A. Do I think you're going to have to do that in this context? I do not, but they will test you on total return, and they will test you on this idea of the 32% standalone, not this separate question about the qualified dividend and just knowing that it's a lower rate. The other way this gets tested is the idea that your marginal tax bracket, you're not going to pay all of that. So just this idea of your effective tax rate. So for example, not every dollar you make in California is taxed at 13%. I think it's after you go past like $5 million in income, then it's 13%. 3 years back, Elon was the largest taxpayer in the state of California because he sold $9 billion worth of Tesla stock. And then he moved to Texas. He said, I won't be paying that again, right? By the way, so then the thing would be, what's Elon's effective rate, right? He didn't pay 13% on everything. It was the amount that was over, whatever the case may be. All right, so it looks like we got Alexander into the mix with a 7 question. All right, let's knock that out, and then we'll get some more from Charlotte. So Alexander, I'm using Notman Cubic. Oh, I don't know if I can bring it up. I've been talking to Brian Marks. I'm not. I told you I'm not monogamous about test prep vendors. Notman Marks is a great firm, white glove, and they used to use the Kaplan Q Bank. So I'm not sure. Do you happen to have Alexander the QID? I can
Yeah,
bring it.
I do.
What does it
Yeah,
say?
it's 39683.
I don't think it's coming up. I think they've probably gone to their own Q Bank at this point. Yeah. Anyways, I'm working with them to see if they'll allow me to go backstage with their Q Bank as well. But oh well. 200,000 equity portfolio. What would you suggest? I like this. This is another question here about systematic risk. If I'm your supervisor, Alexander, and you come in to my office, I say, Alexander, could you step in here for a moment? I say, I see where you bought all these puts on each and every stock your customer owns. You say, yeah. I said, well, if you're buying puts on each of the stocks your customer owns, you're not worried about selection risk, Alexandra. You're worried about the tendency of securities prices to move together. You're worried about systematic risk. So why'd you do this? And you say, Dean, so I can make more commissions. Bad answer. I say, Alexander, if what we're worried about is the entire market going down, the hedge would be buy puts on the index that most closely approximates your customer's portfolio. Right? So here it says appropriate way to hedge your portfolio. I think I would buy the puts. Let's see, buy SPX calls. No. Buy an inverse ETF. I kind of like that one, perhaps. I don't think they give me enough information on the inverse ETF if it matches the portfolio. But in theory, right, if the market goes down, the inverse ETF goes up. And I would be able to say, Alexander, we are losing money in your portfolio, but we're making it up in the inverse ETF. I like that. VIX is volatility. And I like that it says buy a put, but if the market goes down, the VIX goes up. There's an inverse relationship. So that's why I don't like C. Established put credit spread. I think I'm going to go with B, given this answer set. Is B the correct answer?
It is, yeah, and I selected the
That's
VIX. So
That's a tough one. That almost stumped the Series 7 guru. On those ones, you got to do with process of elimination.
Okay.
By the way, I think that's challenging. I would give yourself permission, Alexandra, all of you ladies, to guess B and assign questions to the universe. Because you can burn up a lot of brain cells there. And I told you that's not a garden variety kind of a question. Both Kaplan and Notman have what I call positive variance, which is a good thing, meaning that your scores go up from their questions to the actual question because the test doesn't give you questions like this. They give you more linear kind of questions. But that was a good one. All right, so back to Charlotte here. So I don't know. I got two problems with doing Notman marks, Alexandra. One is I'm afraid Kaplan might think I'm cheating on him. Right. Oh, I forgot we're recording this. I probably shouldn't be having these conversations when I'm recording, but you know, they know I do other things, and Notman does let me put up some of their content on the channel. But I think to let me go backstage would be a major up in the scale of commitment with myself and Notman. All right, so back to Charlotte we go. The buy stop didn't come up. So let's try our next one. 1558 739. With ABC trading at 39, a customer buys a 40 call and sells a 35 call. I think these are the toughest questions on the seven. Spread questions where you're missing premiums. Now, do you know my mantra for these? Dana says, I do. Lower, higher, longer. Lower, higher, longer. Lower strike calls always have greater premiums. Lower, higher, longer. Lower strike calls always have greater premiums. Higher strike puts always have greater premiums. Longer term option contracts always have greater premiums. So that's going to be helpful. Now, this is only one question on your exam, but it's there, and as I said, I think these are the tougher ones, right? So boom. So this is money in, and what we're trying to establish is whether this is a credit or debit spread, because if I can do that, then I'm in business. I can't really answer the question until I establish whether this is a debit or credit spread. Okay, so based on knowing that the 35 call has the greater premium, this is a credit call spread. So now I'm in business because I should know that credit has 6 letters, expire has 6 letters, narrow has 6 letters. Right? So when I have a credit spread, I definitely want the contracts to expire so I can keep the money. And I want the difference in the premiums to get smaller. That's what spread means, difference. So I can close it out and have some money left over. So then it says I got to determine bullish or bearish. And the way we do that is the larger premium dominates the position. The larger premium dominates the position. And the larger premium here is a short call, which is bearish. So I think that one's a tough one. And I'm going to write that down. This is a good one to share with other folks. I'm not sure how many people watch these replays or not, but sometimes
Just a question on that. So because it's trading at 39 and obviously the dominant position has nothing to do with that. Okay.
The only time where it's trading it has anything to do with the question is when they say at expiration, then we care. And we trading. The other thing I would tell you is that I'll also care if it's stock plus options, because if it's a stock, then we paid 39 for it. But the way I think of it, it never matters where the stock's at when I do a trade. It matters where the stock's at when I close the trade. Right. So on the test, when they say when the stock's trading at, that's usually has nothing to do with answering it. That was a tough one. Those are tough. All right, another options question. Another option question. 1564210. A customer, now we care, they told us. The customer bought 100 ABC at 76 and wrote 280 calls at 2. If the stock rises to 83 and the customer is assigned on the short calls. By the way, I shouldn't have to tell you that you had to deliver the stock at 80. You should know that if you have an obligation to deliver stock at 80 and the stock is 83, you're going to have to give up the stock. And I always believe in making a T to track the money in and out of the account. Covered calls are very testable, by the way. I mean, I would expect you to get 3 or 4 covered calls on your Series 7. Now, I like to do things on a per share basis so I don't have to multiply all the way around. I mean, you could put 200 times 76 in there, and then you could put 400 in the inbox. I just think it's a mess. So I personally just like to do a per share. Then when I'm all done, say, okay, well, how many shares are there? That way I only have to multiply once rather than, I also like that too, because it's a little more transparent about what the break even is in this position, which is 74. Right. So that's what I call my initial setup. My initial setup. Now it tells me that I get assigned. So you got to recognize that the 83 has nothing to do with answering the question. Right? Because you don't get to sell at 83. If you wanted to sell at 83, you shouldn't have written the call contracts. That's the disadvantage of a covered call, is you don't participate past the strike price. You don't participate past the strike price. You got to sell the stock at 80. So it looks like I made 4 points on the stock, 2 points for the option. So it looks like I made a total of 6 points on 200 shares. And here, boom, let me just make a little note here. Right? You get exercised or assigned. That's what that means. Right? You're obligated to sell at the strike price. Sometimes the thing that's important is to understand that you don't participate at that. I used to make everybody who traded options did these calls. I'd say, I need you to sign a big girl letter. What's a big girl letter? A big boy letter. I say, well, that you understand that you're going to have to deliver the stock at 80. If you didn't want to do this, like I say, then you shouldn't, do this. The way we say that is that in a covered call, your gain is capped. The way I say it is there's a ceiling, right? I think I would be, I like this one. This one's a good one. All right, let's see what our next one is. Next one is a cost basis question. 1550538. Let me clean up mine. For example, think that for the most part, break evens follow, cost basis follows break even, except here you're buying the put later. So you bought 100 shares of SLP at 95 on April 22nd, 2021. Almost always, I think, as a test taker, when they give me a date, that it's going to be something about long-term capital gains. Right? Because, it kind of speaks to me like, okay, how long have I been at risk in this stock? 3 months later, I purchased a put. Now that interrupts my holding period because I'm no longer at risk, because now I have a choice to sell the stock at 90. I bought at 95. At expiration, the stock was 101 and the option expired. Now, that means you have a $300 short-term loss that you're taking separately, right? Because you already have dealt with that in your tax return in terms of the option. We should know that options can either be traded, they can be exercised, they can expire. And here it expired. By the way, I shouldn't have to tell you it expired. You should know that a 90 put with a stock at 101 at expiration is going to expire worthless. Right? Your choice to sell at 90 doesn't make any economic sense. What is the customer's cost basis? Well, your cost basis is 95. It looks like a lot of Jedi mind trick stuff here about the date, and I was thinking it's going to be about long-term, interrupted holding period. It's not. It's simply what is your cost basis. Now, had you bought the stock right out of the gate with the put, then your answer would be C. And I'm not sure if you missed it with C, but that's a good miss. The good miss is to understand that if you bought the stock at the same time that you bought the put, then it would be C, it would be your break even. The only reason it's not C is because you bought the put later, right? So it doesn't count as part of your cost. There's a tax advantage, so to speak, in buying the put right out of the gate. Could I show the full options matrix? I certainly can. I certainly can. But let me see if we got anything else going on. No. Okay. So here we go. You want to see the full matrix in all its glory? Okay. Let me grab that for you. You might want to take a screenshot of this. Let me boom.
Yeah, I'm definitely going to. I feel like I missed, I feel like I was missing stuff on it or something.
Okay. Well, let's just go find it. Here it is. Boom. Let me go find it for you. And here is the reveal. Here is the reveal. What happened to my matrix? Ah, there it is. Okay, let me go find you guys. Here you go. Can you see my screen? Can you see that? Yes, no, maybe. You guys can't see it? So there's the option matrix. Now, what is not on the matrix, Charlotte? What's not on the matrix, and you can add stuff to it. I don't have the stock on there because stock positions plus option positions are not option positions, right? But you know what's missing on here is that if you're trying to protect or you're trying to do a hedge, I don't have that on here, but you could add it if you want. Brian's added it here that this is how we protect a short stock position. Here's how we protect a long stock position. I don't have spreads on here, but if you wanted, you could put spreads on here. Spreads are when you're same option, different action, right? So you could put that on there if you wanted, right? That would be a call spread, a put spread in terms of the matrix, what sandbox you're playing on. We just did a spread and you were missing premiums and we were trying to determine whether it was a bullish or bearish transaction. And the way we did that, remember, was the larger premium dominates the position, right? Boom. And you could add to this if you wanted to. You could add to this straddles. Here's a straddle. There's a long straddle. You're straddling the strike price line. Here is a short straddle, right? So you can add more things. So maybe that's perhaps, I don't know, perhaps that's what you're, thinking, oh, can I add more stuff to my matrix? The answer is certainly.
Yeah, I was trying to figure out what to add without, I think there's, it's great to have a dump sheet, but I think the markers they give you are bad and you
I'm with
shouldn't
you.
have
Yeah.
one that's, too full.
Totally with you on that. What I would say is that I think the biggest key, the matrix, all these, kind of crutches we have, memory aids and stuff like that, I think would be better if you understand it first and then you are using the memory aid rather than trying to memorize it and then you don't have any kind of conceptual understanding of it. But that being said, um, when you're doing it, I think the first thing I would want to do as a test taker, Charlotte, RTFQ. I'd like to read the full question and decide, is it an option question about a speculator where the matrix does work? Speculation means an option position in which you don't have the stock. You may end up with the stock, but you don't have it when you do it. You're simply speculating. You're simply buying the volatility or selling the volatility, right? That means buying volatility means you're on the left side of the matrix. You're either buying upward volatility or buying downward volatility, right? Are you selling volatility? What I mean by that is once you do that, then they'll say, oh no, there's stock. This is a hedge. The stock is dominating. So I believe in options first, just doing a binary kind of reading of the question to say, okay, am I being asked about a speculative position? That would be long call, long put, short put, spreads and straddles. Or am I being asked about a stock position, long or short? I'm either long or short the stock. And that's where a lot of people mess up, is because they get focused on the stock and are the option and not stay focused on the stock. Let me give you an example of what I mean by that. So boom, boom, boom. So I can't tell you how many people will be looking at this position, for example. Here's one right here. And they say, oh, Dean, I've got such a good handle on options. Not going to trick me. I know that the break even is 32. I'm a bear. My max loss is the premium. My max gain is break even to 0. And, you got to be focused on the stock. So you say, oh, this is not an option position. This is a stock position. And now it doesn't matter what option I add to this. You got to know that this is the dominant thing going on. You can't let options tail wag stock dogs. That's a bullish transaction, right? So I think that's where either most people get the hedges and not the speculative positions, or you get the speculative positions and not the hedges, right? That's a hedge. Here's another one, right? Somebody goes, oh, yeah, Dean, I know. Break even's 52. The option expires. I make $700. Unlimited risk. I go, eh. No, no, no. This is a stock position. The stock dominates. You got to stay focused. So I think it's a binary kind of thing to decide, is it a stock position or not? By the way, and then the other thing people struggle with is getting the break even. And I think it's easy when you got more things going on, I guess. Buy, or sell, you add. Right? So usually it's strike price less premium, 35 minus 3. But now when you got both things here, you're out of pocket 40, you're out of pocket 3. Buy, pizza. Here, buy, sell, you net. Right? You're out 40, you brought in 7, 33. Right? So I think that's the challenge. All right. Anything else for today? I'll put, by the way, when these are done, Dana, when are you, Dana already left us. Are you here? When are
I'm
you
here.
testing, Dana?
I test next Wednesday, the
Next
25th.
Wednesday. Charlotte, when do you test?
23rd Monday,
Third Monday. And Alexander, when?
23rd on Monday,
This Monday.
like a week from today.
A week from today. And Alexander, you're when?
I just rescheduled for July 3rd. We're meeting on Saturday, actually, you and
Okay.
I, for tutoring.
Okay.
So
So the reason I ask is because when I do one of these, I put up another one. And, I don't want to put up another one and it ends up being after your lady's test date. So I will put up another one Thursday. I know, Charlotte, I'm meeting with you Wednesday. I got to take mom to the doctor again. I apologize, Charlotte. I've had to move her around a couple times just because of mom issues. But I'm
It's
seeing
okay,
you
I have
Wednesday.
more
I'm
time for
seeing you
practice
Alexander
tests.
Saturday. Dana, do we have any more tutoring sessions scheduled?
We just have something today at 5. It was supposed to be tomorrow, but I think you had something with mom.
Oh, yeah. So coaching. So yeah, see you tonight. So I'll put up I'll put up another office hour Thursday. Does that work for everybody?
That's perfect.
Yeah.
Okay, so I'll
perfect.
put up another one Thursday. And this one I did in the morning because I'm off grid. It gets really hot in the afternoon. It doesn't speak to me to be. I have an air conditioner in my studio, but it struggles a little bit. I gotta upgrade. I gotta level up my air conditioning out here in the middle of nowhere. So morning work, Thursday morning. Does that work with
Yeah.
everybody? Okay, so
Mhm.
I'll just make it the same time Thursday, right? So I'll put it up. It won't be up until I get a chance to go backstage and put up the tab, but I'll be up. And so we'll see you Thursday. Should be a good week next week. We get some more testing victories. Woo! We've been in pretty good shape here lately. The testing gods have been smiling favorably upon us. So let's test before we we lose their favor. Can you believe it? People are kind enough. I have a person I'm tutoring. She's doing a practice final tonight, and she's giving me permission to put it on the channel. And when people give me permission to do that, this guy commented on the person who's sharing the final, like how confused she is and how smart he is. And I'm like, you are so rude. I said, that person is sharing with you and you should be focused on your test. and not somebody else's as test taker. So the comment should be about the test, not this particular test taker. She passed, and and if you do things like that, then people aren't going to give us permission to put people on the channel. Then I said, and you're losing the favor of the testing gods. They don't like hubris. They don't. They that man. And I felt like telling him, you are at risk now, man. You're tempting the testing gods with comments like that. All right, everybody. I'll see you Thursday, same bad time, same bad channel. Bye.
Thanks.
Thank you.
Thank you.
Bye.